You sold your strongest position for a small gain, watched it continue without you, and promised that next time you would hold. Then the next winner reversed because you refused to sell. These appear to be opposite mistakes, but they often come from the same weakness, allowing the profit to change your judgment. Fear takes the first trade away from you. Greed keeps you trapped in the second. In both cases, you stop reading the market and begin reacting to what the money means to you. A winning position creates a peculiar pressure. As the gain increases, the mind starts treating an uncertain market outcome as personal property. A routine pullback feels like money being taken from you. At the same time, every new high tempts you to imagine how much more the trade might deliver. You become divided between protecting what exists and demanding what has not yet been earned. That division is dangerous because the market does not know your entry price, your target, or the plans you have made for the profit. It only reveals whether demand remains strong enough to support the advance. If the position is behaving properly, an ordinary reaction may be nothing more than part of its movement. But if buying is weakening, price is failing to recover, and the character of the trade has changed, patience can quietly become denial. The difficult task is not simply to let winners run. That phrase is incomplete. A trader must hold while the market continues to justify being held, and recognize when the desire for a larger profit has replaced the original reason for owning the position. Notice what happens inside you when a winner moves in your favor. Are you watching price structure, volume, and the quality of each recovery? Or are you calculating what another 10% would buy? Are you concerned because the market has produced evidence of weakness? Or because the open profit has fallen from its highest point? Those are not the same observations, and confusing them leads to costly decisions. A hypothetical example makes the distinction clear. Suppose a position advances, pauses on lighter activity, and then resumes its rise with renewed demand. Selling merely because the gain feels unusually large may mean abandoning strength without market evidence. Now suppose the same position repeatedly fails at new highs, declines with increasing activity, and cannot recover important support. Holding only because it was once your best winner is no longer discipline. The evidence has changed, but your attachment has not. Before entering any trade, decide what behavior would support continued ownership and what behavior would warn that the premise is weakening. Avoid letting the profit itself become your signal. A large gain can remain healthy, and a small decline can reveal serious damage. Your responsibility is not to predict the final top. It is to separate normal movement from a meaningful change in character while accepting that uncertainty can never be removed. That separation begins with a few quiet distinctions between conviction and attachment, patience and passivity, an orderly reaction and the first sign of distribution. And unless those distinctions are made before emotion becomes urgent, greed will rarely announce itself by name. A trader will often spend an hour deciding where to enter and less than a minute deciding what will justify staying. The entry is precise, the ownership is vague. Then the position begins to profit, and every new price becomes an invitation to revise the terms. That is where greed first gains room to operate. It does not always appear as wild ambition. More often, it appears as negotiation. You plan to reassess under one condition, but now you want to wait. You intended to act if the premise failed, but the open gain makes delay seem harmless. The decision is no longer being made by the trader who studied the opportunity. It is being made by the trader who has something to lose. A holding contract prevents the change of authority. It is a short agreement written before entry, while the outcome still carries no emotional weight. It states why the trade deserves ownership, what must remain true for ownership to continue, what event would require reassessment, and what action follows if that event occurs. The purpose is not to predict the highest price. No serious plan can do that consistently. The purpose is to decide which facts will control you once money begins testing your discipline. Without that decision, each favorable move creates a new standard, and each uncertain moment demands another judgment. Repeated improvisation feels flexible, but it often means the trade has no governing principle. The contract must separate expectation from obligation. You may expect a strong advance, but the market owes you nothing. You may hope to hold for a large move, but hope cannot define the conditions of ownership. The contract therefore deals only with what you will observe and what you will do. It does not contain promises about how far the position should travel. Suppose, hypothetically, a trader enters at 50 because a specific setup has been completed. Before entry, the trader records that the setup loses validity below 47, that the position will be reviewed at predetermined intervals, and that no change will be made merely because the trade shows a profit. The exact numbers are not important here. They must come from the trader's tested method. What matters is that the terms exist before the position can influence them. The contract should also define the difference between a review and an action. A review means the evidence is examined. It does not mean something must be changed. If every review automatically produces a new stop, a new target, or a new decision, then monitoring becomes interference. The contract gives you permission to leave a valid position alone. Keep the document brief enough to use under pressure. Write down 4 things: the original basis for the trade, the condition that permits continued ownership, the event that demands reassessment, and the action required if invalidation is confirmed. Ambiguous phrases such as "looks weak" or "profit is large enough" are not rules. They are openings through which preference can enter. Once the trade is active, new information may justify a legitimate amendment, but an amendment should require evidence that would have mattered even if the position were not profitable. Ask yourself, would I change this rule if the trade was still near my entry? If the answer is no, the market may not have changed, only your relationship with the outcome has changed. A written contract cannot remove uncertainty, and it cannot make obedience effortless. It can only preserve the reasoning formed before desire had a vote. Yet even a sound contract becomes difficult to follow when the position carries more weight than the trader can calmly bear. And that problem begins with the amount placed at risk. A position can be correct in direction and still be almost impossible to hold correctly. The difficulty may not come from weak discipline. It may come from carrying more exposure than your judgment can support. When size is excessive, an ordinary price movement creates an extraordinary financial effect. Your attention leaves the trade and moves to the account. Every fluctuation begins to feel like a demand for action because the amount involved has become more important than the information being produced. This pressure works in both directions. A decline creates an urgent desire to escape. An advance creates an equally dangerous desire to protect, celebrate, or mentally spend the gain. In either case, size causes the position to occupy too much space in your thinking. You are no longer observing one trade among many possible outcomes. You are watching an event that feels capable of changing everything. A holdable position is not one that produces no discomfort. Uncertainty always carries some tension. It is a position whose normal movement remains small enough that you can continue making deliberate decisions. If every minor fluctuation changes your breathing, your attention, or your willingness to follow your method, the position may already be controlling you. The proper calculation begins with the amount you can accept losing if the trade fails, not with the amount you hope to make if it succeeds. From there, position size is determined by the distance between the entry and the point at which the planned loss would be taken. The wider that distance, the fewer units the position can carry for the same account risk. Consider a hypothetical trade with an entry at 60 and a planned exit at 56 if it fails. The risk is $4 per share. If the trader's predefined loss limit for that trade is $400, the basic calculation permits 100 shares before transaction costs, slippage, or gap risk are considered. Buying 400 shares does not make the opportunity 4 times better. It merely turns the same market idea into $1,600 of planned exposure. That difference changes behavior before it changes the result. With 100 shares, a $1 fluctuation represents $100. With 400 shares, the same movement represents $400. The market has done exactly the same thing, but the trader experiences a different event because the exposure has multiplied the emotional consequence. This is why size should not be selected by confidence. Confidence is an opinion, and opinions become most persuasive when risk is least visible. Size should come from limits established at the account level and from the actual distance required by the trade. If the calculation produces a position that feels too small to be exciting, that may be evidence that the trader was seeking stimulation rather than controlled exposure. You can test the holdability of a position before entering it. Calculate the effect of a routine adverse movement. Consider the realistic loss if execution is imperfect. Then ask a simple question. If that amount appeared on the screen, could I still evaluate the trade without needing immediate relief? If the honest answer is no, reducing size is not weakness. It is a way of preserving decision quality. The goal is not to remove feeling. It is to prevent financial pressure from becoming the hidden author of every decision. A trader who must constantly fight the size of a position has little attention left for the market itself. Once exposure is small enough to permit clear judgment, another difficulty appears. You must still accept that a meaningful winner will rarely move in a straight line, and whether tolerating that uncertainty is worthwhile depends on the mathematics of the entire trading method. A trader can be right more often than wrong and still lose, because correctness is counted in trades while results are counted in money. 10 small victories may look impressive, but 1 or 2 ordinary losses can quietly erase them. The comfort of frequent profit can hide a weak payoff structure. Every method has 2 basic dimensions: how often it succeeds and how much it gains or loses when it does. Neither number has meaning by itself. A high winning percentage can support a sound method when losses are kept much smaller than gains. It can also conceal a method that collects modest profits while remaining exposed to larger setbacks. Consider a simple hypothetical illustration. One method wins 6 trades out of 10, gaining 1 unit on each winner, but loses 2 units on each of the other 4 trades. 6 units are gained and 8 are lost. Another method wins only 4 trades, but gains 3 units on each winner, while losing 1 unit on the remaining 6. The second method is wrong more often, yet its payoff structure is stronger. This is why some winners must be given room to become meaningful. If a method depends on gains that are larger than its losses, taking profit at the first comfortable moment changes the mathematics. The trader may still use the same entries and take the same losses, but the profitable side of the equation has been shortened. What appears to be caution at the level of one trade can become a costly habit across a series. Holding, then, is not an attempt to extract the last possible amount from every advance. That would be greed without structure. The purpose is to preserve access to the larger outcomes the method requires. You do not know in advance which trade will produce one of them. If you demand certainty before holding, you will usually recognize the exceptional winner only after you have already sold it. There is a cost attached to that access. A position that may develop into a substantial winner will rarely display its final profit without interruption. Some open gain will appear and disappear along the way. That temporary surrender is not automatically a mistake. It can be the price of remaining available for a move that is larger than the first easy profit. The distinction between patience and greed lies in function. Patience allows a trade to fulfill a defined role within the method's expected distribution of outcomes. Greed asks one trade to deliver as much as imagination can assign to it. One accepts that the larger outcome may never arrive. The other begins to depend on it. You should know which structure your method requires. Using tested or carefully recorded results, estimate the winning frequency, the average gain, and the average loss. These figures will never predict the next trade, but they can reveal what repeated behavior must accomplish. Then examine what happens mathematically if winners are capped at the level where you usually feel tempted to secure them. The calculation is simple. Multiply the estimated win probability by the average win, then subtract the estimated loss probability multiplied by the average loss. The result is an estimate, not a promise. Its value is that it exposes whether early profit taking supports the method or quietly destroys its expected advantage. Not every approach needs rare, extended winners. Some methods are built around smaller, repeatable gains. Holding longer simply because large profits are attractive would be another form of greed. The required holding behavior must come from the payoff structure, not from a preference for excitement or comfort. Once the mathematics shows that certain winners need room, the problem becomes more exact: which price movements are relevant to that opportunity and which are merely noise. That answer begins with the time frame on which the trade was actually built. A sound position can be ruined by watching it too closely. The trade may have been built to unfold over several days, yet a few minutes of contrary movement are allowed to decide its fate. Nothing important has changed in the original setup. Only the distance from which you are observing it has changed. Every market movement contains smaller movements running against it. A weekly advance is made of rising and falling days. A daily advance is made of rising and falling hours. When you move to a shorter chart, you do not discover a more truthful market. You discover a more detailed version of the same uncertainty. That detail carries a cost. Shorter time frames produce more signals, more reversals, and more moments that appear urgent. The more events you watch, the more opportunities you create to interfere. Activity then begins to resemble attention, even when it adds no useful information to the decision. A trade should therefore have a governing time frame. This is the scale on which the opportunity was identified and on which its continued validity will be judged. Other time frames may assist with execution, but they should not quietly take control of the position after entry. Suppose, hypothetically, you enter a trade because of a pattern completed on the daily chart, expecting the idea to develop over several sessions. Later, a sharp 30-minute decline appears. On the intraday chart, the movement looks severe because it fills the screen. On the daily chart, it is a small portion of an unfinished bar. If you exit solely because the lower chart looks threatening, you have asked 30 minutes of information to overrule a decision built from months of data. This does not mean a shorter time frame has no value. It may help you enter with greater precision or execute an action efficiently. But execution and judgment are different responsibilities. A tool used to place the trade does not automatically deserve authority over whether the trade should continue. The reverse mistake is also possible. A short-term trade should not be converted into a long-term position simply because the immediate outcome is unfavorable. Moving to a higher time frame can make damage appear smaller, but visual comfort does not change the original horizon. Time frame integrity works in both directions. You do not shorten a trade to escape normal movement, and you do not lengthen it to avoid admitting failure. Before entering, name the governing time frame in plain language. Decide when decisions will normally be made: during the bar, at its close, or after a fixed review point. Then keep lower time frame observation limited to tasks that were assigned to it in advance. If it has no defined role, it is likely to produce motion without clarity. When the urge to act appears, ask what has changed on the time frame that created this trade. If the answer concerns only a smaller fluctuation, you may be responding to magnification rather than meaningful change. The question does not tell you to hold. It tells you where the evidence must come from. Consistency matters because observations taken from different time frames cannot be compared cleanly. A position judged by daily structure in the morning, hourly movement at midday, and minute-by-minute action near the close has no stable standard. Each new scale changes what appears significant, so the decision moves even when the market's larger condition does not. Once the governing time frame is fixed, the noise becomes easier to place in context. But the correct chart alone cannot tell you whether a winner remains healthy. You must still learn what strength, hesitation, and deterioration actually look like within the chosen frame. A winning trend rarely reveals its condition through one dramatic moment. More often, its character changes by degrees. The advance becomes harder, the recoveries become weaker, and progress begins to require more effort. If you watch only the amount of profit, you may miss the market's quieter evidence. Strength does not mean that price rises without interruption. A healthy advance needs reactions because earlier buyers take profits and new buyers test whether the position is still worth owning. The important question is not whether selling appears. It is how much damage that selling can produce. When supply enters a strong position, declines tend to remain controlled relative to the advances that preceded them. Price may retreat, but sellers struggle to force lasting damage. When demand returns, progress becomes easier again. The imbalance is visible. Downward effort produces limited results, while renewed buying moves price with greater efficiency. Weakness reverses that relationship. Advances require increasing effort but cover less distance. Price may trade actively near a high without making meaningful progress. Then a modest increase in selling produces a decline that would previously have required far more pressure. The market is telling you that demand is no longer absorbing supply with the same ease. This relationship between effort and result is more useful than volume by itself. Heavy volume is not automatically bullish or bearish. It must be judged by what price accomplishes with that activity. If participation expands and price closes firmly after making clear progress, buyers may still have control. If activity expands but price repeatedly fails to advance, substantial buying effort may be meeting an equal or greater amount of supply. The location of the close adds another piece of evidence. A position that repeatedly reaches new territory but closes well below its best levels is showing that higher prices attract selling. One such session may mean little. A sequence of them, especially when each attempt travels a shorter distance, suggests that the advance is losing authority. Recovery behavior matters as well. After a decline, does price regain lost ground with purpose, or does it rise reluctantly and stall below the prior high? A strong recovery shows that buyers remain willing to compete for the position. A weak recovery shows that sellers no longer need to be aggressive. The absence of demand is doing part of their work. Consider a hypothetical position that has advanced through 3 clear upward legs. The first 2 legs travel substantial distance with firm closes. The third pushes above the previous high several times, yet each attempt ends near the middle or bottom of its range. Activity increases, but the position gains little ground. When it finally slips, the decline covers in 2 sessions what the prior advance required 6 sessions to achieve. No single bar proves the trend has ended, but the balance of effort has changed. You should read that balance as a sequence, not as a collection of isolated signals. Compare the distance of each advance, the depth of each reaction, the quality of the closes, and the ease of each recovery. One weak session can be noise. Repeated deterioration across several measures is evidence. This approach prevents 2 opposite errors. You do not abandon a healthy winner merely because selling appears, and you do not excuse persistent weakness merely because the position is still above your entry. The entry price describes your history. The current sequence describes the market's condition. The practical question is simple: which side is accomplishing more with less effort? As long as demand continues to produce meaningful progress while supply produces limited damage, continued ownership has market support. When that relationship reverses and remains reversed, the justification for patience begins to weaken. Yet a position never trades in complete isolation. The same internal behavior can carry different significance when the surrounding market is advancing freely, rotating without direction, or rejecting breakouts across entire groups, and that broader permission must be examined next. A winner does not travel through empty space. It moves inside a market that may support continuation, resist it, or offer no lasting direction at all. The same setup can produce a sustained advance in one environment and repeated frustration in another because the surrounding conditions change. What price movements are likely to persist? In a trending regime, capital tends to remain committed to successful areas. Leadership holds from one period to the next, advances attract further participation, and temporary weakness is more often met by willing buyers. This persistence gives a sound winner time to develop because the market is rewarding continuation. A range-bound regime works differently. Strength attracts selling near familiar boundaries, weakness attracts buying near lower ones, and apparent breakouts often return to the range. Price may move sharply without traveling far. In that environment, patience can become expensive because the market repeatedly takes back progress instead of building upon it. The most difficult period is often the transition between these conditions. An old trend begins losing participation, but a clear range has not yet formed. Moves remain large enough to look convincing, yet their direction changes quickly. Traders continue applying the habits of the previous regime after the market has stopped rewarding them. You do not identify a regime by giving the index a convenient label. You identify it by studying the behavior of the field. How many instruments are participating? Does leadership persist? Are fresh breakouts holding beyond their first advance? Do weak sessions attract support, or does selling spread from one group to another? Breadth matters because a narrow advance depends on fewer sources of demand. An index may continue rising while most components weaken beneath the surface. As participation contracts, individual winners receive less support from the market as a whole. Their continuation becomes more dependent on isolated demand, which can disappear quickly. Leadership persistence offers another clue. In a durable trend, the strongest groups tend to remain influential long enough for positions to mature. In a rotational market, one group rises while another falls, then their roles reverse. A position can appear strong for a few sessions simply because capital has passed through its sector, not because a lasting trend has formed. Consider two hypothetical trades with nearly identical entry setups. The first appears while the broad market is advancing, participation is expanding, and related instruments are holding recent gains. The second appears while the index is moving sideways, leadership changes every few days, and recent breakouts are repeatedly returning to their starting points. The chart pattern may look the same, but the second trade is asking the environment to behave differently from its recent character. This does not mean the broader market should overrule everything an individual position does. Regime is context, not a command. A favorable environment cannot repair a failing trade, and an unfavorable environment does not make every advance impossible. It changes the degree of evidence required before you assume that strength will continue. A practical way to stay aware is to keep a short live record of market conditions. Track participation across major groups, the persistence of leadership, the success or failure of recent breakouts, and whether broad weakness is being repaired or extended. The purpose is not to forecast every turn. It is to notice when the market stops rewarding the behavior your holding method depends upon. As continuation becomes broad and persistent, a healthy winner receives more permission to develop. As follow-through disappears and rotation increases, that permission becomes narrower. The holding decision must adapt because patience has different value under different conditions. Even when the regime supports a longer move, however, the trader can still create pressure where the market has created none. The moment an unrealized profit reaches a memorable high, the mind begins treating that temporary figure as something already possessed, and the next ordinary decline is no longer seen in the same way. The market can take nothing from you, yet you can still feel robbed. A position reaches a large unrealized profit, retreats slightly, and the missing portion begins to feel like a real loss. From that moment, you are no longer comparing the present with your entry. You are comparing it with the best number you happen to see. That highest number is only a temporary valuation. It records what the position was worth at one moment under conditions that no longer exist. Unless the trade was closed there, no exchange took place. The profit was visible, but it was never secured. The mind does not respect that distinction easily. Once a higher profit appears, it becomes a new reference point. A position that is still deeply profitable can then feel unsuccessful because it stands below its peak. The trade has not necessarily become poor, but your measurement of it has changed. This creates two opposite reactions. The first is an urgent sale made to stop the sensation of losing more of the peak. The second is stubborn inaction, driven by the demand that price return to the high before any decision is accepted. One reaction escapes the anchor, the other waits for the anchor to be restored. Both allow a past quotation to govern the present. Suppose, hypothetically, a position is purchased at 80, advances to 100, and later trades at 94. The trader says, "I have lost 6 points, but relative to the completed transaction, nothing has been lost because no sale occurred at 100. Relative to the entry, the position remains 14 points higher. The 6-point loss exists only against a reference created after the trade began. This does not mean the decline from 100 should be ignored. It may contain useful information, or it may not. The important point is that the distance from the peak has no meaning by itself. A 4-point retreat after a disorderly rise may carry one message. A larger retreat after an exceptional move may carry another. The peak alone cannot make that distinction. A useful test is to remove the peak from the decision. Hide the profit and loss display for a moment and look at the position as it stands now. Ask yourself, if I had never seen the higher quotation, would the present condition demand a different action? If the answer changes only because you remember the missing profit, the anchor is speaking louder than the market. Your trading screen can strengthen this distortion. A constantly changing currency figure turns every movement into a personal gain or loss. Price is market information. The flashing profit figure is an interpretation of what that information means to your account. When the second begins controlling the first, reduce its visibility.